The Diwali boom continues. Yesterday we spoke about the festive sales. Today let's talk about the stock market. Well, just like the Diwali rockets, they're going in just one direction, and that is up. Look at the Sensex first. It was trading at around 80,000 towards the end of September, and now it's around 84,400. So the Sensex has risen by more than 4,000 points in 20 days. It's just 1,500 points off the all-time high. Same with Nifty. It was trading at around 24,800 when October started. It is now over 25,800. That's over 1,000 points gained in October. Many are calling it the start of a new bull run. It follows a period of gloom in the Indian markets. The question is, what has changed? What is driving this surge? Three things mainly. Number one, the return of consumer confidence. We mentioned this yesterday. Indian consumers shattered a Diwali record this season. They spent some $68 billion on goods and services. That's a trading record in Indian history, $68 billion. This spending bump has helped Indian companies, especially those selling cars and electronics. That's the first reason, consumer confidence. Reason number two, better earnings than expected. Multiple Indian companies reported their earnings this weekend. Some of the heavyweights had a great showing. Reliance Industries rose 3.5%. Public sector banks were up 2.9%. These heavyweights also dragged the market up. And finally, reason number three, the return of the FIIs. Foreign institutional investors, FIIs. Until recently, they were taking money out of India. Almost 2 lakh crore rupees was pulled out in 2025 alone. They felt the Indian markets were overvalued. So they shifted outside. But that could be changing. In the month of October, FIIs became net buyers in the Indian market, meaning they bought more than they sold. How much? Nearly 7,300 crore rupees. Let me put that in perspective for you. In the last 3 months, FIIs were net sellers. Their outflow stood at 76,000 crore rupees. But in the month of October, that flipped. They bought 7,300 crores in shares. So recent trends suggest that FIIs are back. A big reason for that is the macroeconomic stability. We're talking about things like inflation, growth, trade. A lot of countries are struggling on these fronts. Their exports have been upended by US tariffs, their inflation is yet to stabilize after the pandemic years, and their growth continues to be stagnant. But India is an outlier. Let's look at trade first. India faces 50% tariffs from the United States, yet our goods export actually grew in the month of September by almost 7% to $36 billion. How did that happen? Thanks to diversification. India has been taking steps to reach other markets, basically plug the gap left by America. We have started exporting seafood to Australia after 8 years. We are ramping up pharma exports to Africa, and we are looking at new partners in Latin America and Southeast Asia. Indian exports to 24 countries expanded in September, 24 countries. The list includes the UAE, Germany, Egypt, Kenya, Brazil, and Italy. Even countries like Canada and Bangladesh. And don't forget the new deals. India has sealed a free trade agreement with the United Kingdom, plus a deal with the European Union is in the works. So trade stability is working for India. That's the first factor. The second one is inflation. India's retail inflation fell to 1.54% in September. That's the lowest in 8 years. And investors look for these cues before putting money in. They look at the inflation rate, they look at the trade situation, they look at the policy stability. In India, they're finding all three together. Let's see if the momentum continues.
Want the facts?
The latest developments?
News that gets straight to the point.
Well, we've got all three just for you. This is Firstpost Live, a brand new show, your window into what really matters.
Don't miss it.